Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you gotta get spotted. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Well, today is Federal Reserve Day. Aren't you excited? I'm excited. I kind of wonder, I mean, they're not going to change rates. So this is another, well, hold on. Let's get the window open. Let's check out the charts a little bit before I get into what I think is going to happen for Federal Reserve Day. Here are the treasuries. The auction yesterday was awesome. You see that jump there? That was a pretty strong auction. And I was really surprised just because I was kind of like, who's going to buy like the day before the Federal Reserve? But it was just an absolutely stellar auction from almost every metric. And it could really shift the market. We'll see, but I'm kind of wondering if all these people that are going short here can get squeezed at some point. S&P 500, they're a little bit higher today, but it's still trading, and I would say it's starting to form a narrow band here. Waiting for the FOMC meeting. Here's oil up, good clip from yesterday. Gold took a little bit of a hit yesterday, but I mean, it still kept a lot of those gains, so gold is looking pretty good. And silver, still just lagging. Copper maybe breaking the trend line there. Japanese yen up, and the dollar still flat around $99. And Bitcoin 97K still. Remember me? Of course. So anyways, I'm not sure, like, would Powell say anything that would really move the markets? Well, I think that at an FOMC meeting, you've got all of these people ready to pull the trigger, you know, essentially. Like, they want to take a trade. So they might take even the tiniest thing that he says and turn it into a big thing and have a big market move off of that. But, like, what could he say that might change Seth's opinion, like my projections of how the Federal Reserve will act and everything? I'm not too sure, but the one thing that I think is maybe a little bit up in the air, they have asked him about this before, but, you know, the place where maybe you might hear something a little bit different from him is, what do you do when the Federal Reserve's dual mandates come into conflict? So, and what do you do with this situation where you're getting inflation, but you're also, it's temporary and the economy is weakening? So we'll see. Naveed asks my opinion on crypto arbitrage strategies. Okay, so I have never tried doing this before. There are some risks involved in it, but and it has become a much more competitive landscape. But if you are finding opportunities and you've got the skills, I would go for it. Yeah, I've been thinking a little bit more broadly about, like, what we're going to do here, because I really feel that 90 minutes on the stream is just not enough. But that's the situation. That's where we're at right now. So what do we do? Well, I'm kind of thinking I'm going to have to rely more on my robots. By the way, we should turn that on. I think that I'm going to need to rely more on my robots and automated strategies and so forth. So I think I need to do a little bit more research on the machine learning. That's something that I've kind of gotten into a little bit here and there, but I don't really feel like I've really found the deep dive that I want to really understand how they're, what kind of machine learning strategies are effective aren't. I found this cool thing yesterday. It was called a deflated Sharpe ratio. And basically what it does is it's saying, well, if you're taking a strategy and you're like optimizing the parameters on it, then you're more likely to fall into the data snooping bias, which is exactly what happens and is what I have found has happened. And so they're basically able to go in and say, like, what would be like the max Sharpe that this strategy could actually have? And then somehow based on that, I didn't really understand all of the math on it, to be honest, but it's something you can look up. Based on that, they determine like the results that you got, the Sharpe ratio that you got, what is the chance that it's not random, essentially. And so it kind of optimizes the number of iterations that you're doing on testing a strategy to, avoid those biases, essentially. So I really like that. It seemed like something that could help. I don't know if I could implement it in NinjaTrader, though. So then that was kind of what got me to thinking, well, some of this that we're doing is like, well, I need to kind of get some of the analysis outside of NinjaTrader. There we go. Can we make a strategy with a Monte Carlo simulation? I don't think that a Monte Carlo simulation is really good at like formulating a strategy per se. So one of the things that we do, and NinjaTrader can do this, is it kind of like will randomize the data that you do have to kind of say, okay, like this is how the strategy performs, but like if things had been just a little bit different, like how much variance could you actually have in your strategy? And then you can kind of see the range of possibilities, right? Because a Monte Carlo simulation is essentially like try all of the possibilities, and then that will reveal if there's a tendency for things to go a certain way. Yeah, I think that I need to try and find a better way of doing like fuzzy how do I say this? Like I need to get into the hidden Markov models and things, because essentially what we're doing is we're saying we're looking for a certain state, and then we're looking at all of these different indications and saying, is the market in this state? Okay, when I look at trend and cumulative delta, does that suggest that we are in that state? Right now, yes, actually, by the way. Right now, it suggests that we're in a buy meta order. Even though, the amount that we've moved on the upside is kind of limited, but the flows suggest that we're going long. Okay, so like that's just one thing. And then I could add all of these other things up together to say, okay, so what is the probability that we are in that market state? And, could be like, okay, we do have strong R squared in the cumulative delta, but then like, what is the absolute change in cumulative delta? Because the higher the absolute change in cumulative delta, that might make me even more sure, right? And how do you like score all of those sorts of things? That's something that I would really like to figure out that could really help us. But I just don't, 90 minutes isn't long enough. So I really think that I need to spend more of my time focused on building. I see a good indicator about it in TradingView, but the problem is every time that market's changed, I have no clue what it's doing. I'd be kind of skeptical of the indicators that you see on TradingView. Yeah. Because, it's a great way to sell. I probably should have, if they did order flow stuff, I would probably be, the best gig for me would be to convert everything over to TradingView, because there's more people over there. And then like their backtester is just not very good. So it's kind of funny, like you take a strategy. Is the strategy like actually effective? Well, the only way that you can know is backtest it, right? But then if you backtest it and you get pretty good results from it, there's like limitations in the backtester too. So like the job is not done there. Kind of crazy. Okay. Fifth Dimension's comment there. I was it on the B where they had this joke that the Democrats were gonna pay people $1,001. Oh, that's right. Because okay, I didn't see that. The Trump administration offers $1,000 to self-deport. That's what it was. And then the news story was, Democrats will offer you $1,001 to not deport. I was like, what? But I mean, if you only need $1,000, that's not that hard to get your hands on. By the way, I should kind of check around and see what we got going here. Why do I trade futures instead of other assets like stocks, options, and forex? So I have a video on that. That was like, was it the last video I put out? It's maybe a certain amount back, but the issue with stocks is that you are subject to the pattern day trader rule. That's the biggest problem in stocks. Is you have to have, I always forget the number, $15,000. And if your count is less than $15,000, then you can only have like 5 or like 3 day trades within a 5-day period or something like that. So that really, really limits you. And there's also issues with leverage. So like if you don't really have a whole lot, then it's kind of hard to make a consistent amount of money from it without getting into really, really risky plays. So, but there are a lot of opportunities in stocks because, one, spreads are bigger over there and order flow is less common. So there's probably more opportunity for us to find edge. And there's more instruments to pick from. So you can always find an instrument that is in the state that you're looking for. So that's one of the things that makes stocks beneficial. I would say, generally speaking, if you were like kind of doing like a pseudo day trade, swing trading in stocks, and you were mostly buying, you probably have a higher chance of making money than futures. So I wouldn't necessarily say that you have like edge, but if we were to say your alpha is 0, most traders, their alpha is negative, okay? But if your alpha was 0 in futures means you lose everything. 0 in stocks means you make a little bit. So from that perspective, that's probably why you hear people say like stocks are easier to trade. Okay. But if you're really day trading and you're looking for like daily opportunities and so forth, there's really nothing better suited to that than futures. You can trade it with a very small amount of capital. You can you get good leverage, and you get instruments that are very economically sensitive. So that's one of the issues with stocks is like, if I want to play the FOMC, like what's really the best way to do it other than like trading SPY? But then like, why wouldn't you just trade the ES futures? Why would you trade SPY instead of the ES futures? I really don't see why you would do that unless you wanted to use the SPY options. Well, the level 2 activity in the 10-year treasury today is very, very low. We are getting a bit of we were getting a pretty decent meta order long, it appeared. But the level 2 activity kind of suggests that there's not going to be much opportunity for us this morning. U.S. Secretary of State Rubio has spoken with counterparts from India and Pakistan. Am I the only one that's weirded out by Rubio becoming like one of Donald Trump's favored people in the administration? Like when they asked him about like who would pick up the mantle after him, he mentioned JD Vance and he mentioned Rubio. I was like, oh wow, because when they were running in their primaries, I kind of feel like he savaged Rubio the hardest, you know? But is it because Rubio is from Florida? I don't know. It was just surprising to me. I would say that out of any of the politicians that had a job in the administration, Rubio has done the best. I aim to be a quantitative trader. What asset class would be most likely geared towards quantitative finance? Options. Without question, options. In options, there's all sorts of arbitrage opportunities and so forth. Like, there's just a much larger field for you to work in quantitative finance. And you're going to find that a very, very substantial portion of the quantitative finance information that is out there is really about options. Nothing is better than catching a trend in a Forex pair. When it trends, it delivers huge runs that you don't see in futures. Or I don't know about that. Like, futures can definitely run. I mean, I don't know if they're better than futures for runs, but with Forex, you can catch good leverage for sure. The problem in Forex is your ability to actually have edge in Forex is probably the smallest out of any of the assets. You're dealing with, something that is incredibly random. Like Forex pairs are kind of more random than other instruments, in my opinion. And, the people that do have edge are like government insiders. So you're not going to be privy to that information. So your ability to be the informed trader in FX is extremely limited. Okay. The majority Oh, actually, I think Verex is saying in FX macro is edge. Well, so I think that there's kind of two things, right? One is you're making macro trades, right? So if you're making some sort of a trade about like, people are going to move their money from the United States to Europe because yada, 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 yada. All of the things that are happening because of the trade war and things like that, right? Like that's a swing trade. It's a macro swing trade, right? And then Forex can be really useful to you, right? A lot of the activity that happens in Forex market is really like hedging themselves. You know, I have some shipment that I'm going to bring in, and I have to hedge myself against the change in the currencies, and right. So there's a lot of that. But for day trading, you know, for you to have an edge about what is it going to do in the next 5 minutes to 2 hours, there's probably less opportunities in Forex than anything else. So, you know, all of these instruments exist for a reason, but for what we're doing, Forex is not very good. Why didn't you choose to become a quant, though? Well, because by the time I realized that, I was already too far on a different path. And unless I had somehow become a quant and really hit it big being a quant, I don't think that a different path would have given me a better standard of living. And I would have had to move to New York to do it, which I'm not sure I really wanted to do. Like at the time, I would have loved to have lived in New York. I liked what it was like there, but it's gone considerably downhill from 2010. So I'm kind of glad that I stayed in Utah. And the truth is that the thing that I love doing the most is computer stuff. Finance is just kind of ends up being a secondary interest that pairs with it really, really well, right? But I only got interested in this stuff because of the 2008 crisis. And by that point, I was basically already graduating, right? If I had gotten into it when I was in high school, maybe I would have gone to a target school and done finance instead, and it would be a different story. But I get paid pretty well to do site reliability engineering. And I'm quite liking the place that I've been working. So we got like a 3-month contract to hire. They pay me a lot more during the contract than when they hire me. And it's a little, we can negotiate when they hire me. So we'll see what they say. But I think I've been very valuable so far. And, but the thing that I like about it is that I have to go into the office. There's actual people there, and you're actually interacting with the people. So I actually feel like I'm a part of a community at work again. And the people are much more my kind of people. When I worked for Goldman, I really, really liked the people. In fact, I am still very, very good friends with many of the people that I went to training with. I kind of feel like when you're doing the training, you kind of form a bond that just is a special kind of bond. But the day-to-day job at Goldman, it was kind of cutthroat sometimes. And there are some people from that job that I really, really hate. I still think about it and how much I dislike them. Because they were kind of playing the stack ranking game where it was like, I'm going to try and undermine anybody that's competition and yada, yada, yada. Like that absolutely happened. So like you were working with really smart people, but then you're also working with a lot of people that were like actively out to get you. One of my other jobs, you know, like I knew the people on my team pretty well, but people were generally pretty quiet, didn't interact that much. Right. That's not the case at this place. Like everybody eats lunch together, talk a lot. You know, the company really believes in what it's doing. It's a different vibe. And that's what I like about it. So we'll see what happens, but I think that I'll probably end up staying there. I heard only like 2 to 3% get hired at Goldman. Oh, I don't know. I will tell you, the interview process that I went through at Goldman was pretty brutal. It was like, granted, I've seen things in today's market that are really crazy. You know, like I've heard of situations where people are doing like 5 or 6 levels of interviews and things like that. It's really quite silly. At Goldman, it was like there was one interview with the campus recruiting people and then one interview with the group. And I was applying to 2 different groups. And it was like a super day. So like you do 3 sets of interviews back to back. So when I did that, it was basically all day. And the kinds of questions that they would ask were very difficult questions. They were real problem solving questions. They didn't ask me like the quant problem solving kind of questions, but they asked questions that I think any kind of an engineer or a computer science person could answer, because they didn't necessarily require technical expertise, but they did require like the problem solving skills. They were very difficult. And when I did the interview, I was really like, you know, I don't know if I did that well. That was really, really hard. And then they did hire me. And I think that probably one of the big deciding factors was that they could tell that I knew a lot about the markets, that I really cared about the markets. And most people don't. Most people that end up getting hired, you know, like it's just a job. That's kind of one of the things that I think might be one of the problems on Wall Street, is that most of the people on Wall Street care more about the money than they do about the finance and like the role that finance plays in the society and filling that role and things like that. To them, if there was something else that was making more money, maybe they would have gone and done that. And frankly, since that time, that has kind of been what happened, is that group of people, they kind of stopped going into finance and they started going into big tech. So then you get these people in big tech that, you know, they've geared everything to be able to work at Fang, but they don't really enjoy the tech. So that was one of the things that I always, because part of why I wanted to work there was I wanted to get closer to the industry, and I learned a lot about the industry. But most of the people there, they didn't want to talk about the finance or interested in it or interested in the markets. Maybe if I was closer to the trading desks, but so yeah, it was hard to get hired there, but I did. But, you know, it was in Salt Lake, and it was primarily for my interest in the markets, and I don't know if that makes me all that special. Now, one thing that I do kind of think makes me special, and I don't know what it is, but when I started, so I started in 2010, and they call it I forget what it stands for, but they called us NAPAs, basically people that got hired straight out of school, and you go and do training after school. You know, it's like a 6-week training. Okay. And for everybody, it's their first job out of school. And of the people in my Napa class, I think something like 90% left the firm before I did. So some of that is people just move somewhere else. Some of that is like layoffs come through, and then Goldman does a lot of layoffs. They're always shifting things around. So it lasted a long time, relatively speaking. Of course, there's still a lot of the people that I knew that worked there that are probably like lifers, and I'm sure some of them, they just move every two to 3 years. I do wonder, because for most of the jobs I stayed there longer than most people. I make pretty good. So like this whole thing that like staying at the job, like it held you back or it held your income back, that did not happen with me. But I don't know what would have happened if I had gone the other route. Who knows? Did they? Oh, they did push a clip or two higher there, and there's a decent amount of backwash getting absorbed there. So that's interesting to me. So I don't know why this just popped into my head, but you know what? One of the things that I've been saying is like, I don't really think that we've been affected by tariffs yet. We get CPI next week, and I was seeing some people saying like, well, okay, like what is the CPI going to be? If the CPI is high, then does the Federal Reserve push back interest rates or even increase interest rates or something like that? And I'm sitting there thinking, well, I would kind of think that CPI would probably still be what it's been. Like maybe a 0.4, but we don't get estimates for that yet. So I don't really know. So I guess we'll find out next week. Probably by Monday we'll be able to see what the estimates are. But I did come across a situation where the tariffs had mattered. I wanted to get a keyboard, or there's a keyboard that I've been kind of watching, and I've just never pulled the trigger on it because it's like $400 and I don't really need it. And they basically subject to the tariffs, so you couldn't buy anything from their US store for a little bit. And then they have some stock that they imported before the tariffs and everything, so you can still get it for about $400. But like then after that is gone, we'll see what happens. Right now they're subject to 120% tariff. And they said that their importers are working on getting the exclusion so that they can get the 20% tariff instead. So does that mean that the keyboard, you know, like I don't know what their cost is, how much they're making on the keyboard, but like usually the math comes out to be like 50% of the tariff. So like, does that mean that the cost of it is going to go up 10% and it's going to be like $450? So I was really thinking about getting it now, but I decided to wait. So that was one case where I've seen that the tariffs have come into effect, but I still kind of think that we're probably not really going to see the effects of tariffs until like June. And the place, unless you're like buying clothes from Temu. S&P 500 not looking too healthy over the past 5 minutes or so. Might be the treasuries moving up because of equity correlations again. First boats carrying Chinese goods with 145% tariffs are arriving in LA. Shipments are cut in half. Expect shortages soon. Shortages in what, though? I do wonder, because another thing is I got a set of headphones. And they haven't shipped yet. And they kind of said that they were like going to ship next week. But it's next week, and I haven't heard anything. So I wonder what's going on there. Oh, here's something that I might need to comment on. Change my view, but capitalism on work on paper and not in reality, as they say that capitalism is best economic model. Big companies buy small ones and make a monopoly, which makes things more expensive, not cheaper. Instead of creating new ideas, big companies focus on keeping control and stopping fresh creative businesses. Businesses don't always compete fairly. They sometimes cheat to make prices high and control the market. Capitalism promises fair work, but often companies hurt workers and the planet just to make money instead of helping everyone living. Yeah, so I think one of the big problems that I see is that people don't really understand what capitalism is and isn't, and why it's been effective, right? Capitalism is primarily private ownership of businesses. Okay, so all of these things that are like, we allow companies to buy small ones and everything like that is not an issue with capitalism. That is an issue with your country's specific implementation of things. I'm going to write something here. What it's doing here at 10 is is a really frustrating thing, because it'll go back and forth across that, even though it's like at the high, right? Do institutions like Goldman execute their trades using order flow tools, or is it all programming that do the heavy work? So what happens, the way that it works is you have algorithm assisted traders. So the traders, they will have a DOM up on their screen and they will be executing primarily on the DOM, but they have a lot of additional tools that help them. For instance, one of the things that their DOM will do is automatically bid or offer a certain number of contracts at every price simply to save themselves a spot in line. And then there are ways to say, okay, actually, if I can get the fill on that one, I do want to take the fill on those ones. These algorithms will auto stack and auto poll. They will automatically react to correlated instruments and all of these other sorts of things. So they are an algorithm enhanced trader, essentially, right? But these guys, they are utilizing order flow tools and understand the order flow. And one of the things, like I've literally seen this with my own eyes, is them doing things like, okay, we're accumulating some shares here. We've accumulated about as much as we think we can here. So now it is time to push price up, and so that we can create another liquidity hole for us to execute in. And what they will start doing is, I'm going to pull all of the orders that I have at the next offer and then buy everything else that's there and just kind of tick price up. And they were talking about, because there's this one guy, like, that was his job. That was his job, was when they are ready, make price tick up. And he was really good at it. And they were talking about, you know, how he just kind of knew and was good at it for some reason, and the rest of them weren't as good at it. So there was a very much there's reading the order flow and some intuition to it and practice and so on and so forth. I actually believe that with some of the insight that we have, that some of those traders would be interested in the stuff that we say and we're talking about on this channel. But they probably have the time to come and watch us when we're live, right? So, to reiterate the answer to that question, do institutions use their order flow tools, or is it all programming? The reality is that there is a lot of algorithms, and the algorithms assist the trader, but the trader is sitting there with a DOM out, and they do understand and are trading off of order flow. I guess another thing that I should say is you got to realize that the game that they're playing is very, very different, right? They do not sit here and go, okay, do I think that it's going to go up or down today? What do I think about this Federal Reserve meeting? Things like they know all of the things that are going on, because they need to know that stuff to be able to make decisions. But they are primarily serving clients. A client has decided, I want to buy or sell. The client will tell them why they want to buy or sell. That way, if something happens in the middle of execution that would destroy the trade, they can just immediately get out of it instead of having to go back to the client and say, okay, actually, do you still want to keep this? Yada, 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 right? So there's that whole thing. But the direction is already decided for them. And so their job is to buy as much of it as they can without moving the price is kind of their job. So it's fundamentally different what they're doing. And they can see their institutional order flow, which there's a lot of information embedded in that we don't have. But they are using order flow tools. And that was primarily why, when I started learning to trade on my own, that I immediately went into order flow. Because that's was the advice that I got from the traders. I just started using Motivate. You know, GK, I haven't really talked to very many people that have used it, so I don't really have any advice on how to set it up like Jigsaw. But it's kind of one of those platforms that it looks pretty professional, but it's just for some reason most of the retail traders that we're talking to don't use that platform. Word, been away for a week. What is new? Well, let's see here. For a week? I don't know if we've really missed that much. But you came back at a good time because we got the Federal Reserve meeting. I kind of think this is one of those things where, you know, I don't know if the meeting itself is that important. It always kind of ends up being that, like, Powell is probably going to try to say as little as possible, right? But it's like this event that kind of prevents things from progressing forward, right? So what you see happen in the next, you know, today and into the end of the week is probably going to set the stage for the next leg of the market. Let's hope that it's up to sideways, because I'm really concerned that the bear market regime sets back in and we go in for another really big dive. Then very insightful. So when they move price, what is their main aim? I assume their targets is not 5 or 10 ticks, and also what is the logic behind news release price movement? Is it predetermined? Okay, so their primary goal is to execute as much volume as they can without affecting the price. So why then would you intentionally tick the markets up or down? Well, they have found that there are kind of some situations where moving it a little bit now will actually allow them to execute more volume than they otherwise would. And the reason for that is because when you move the markets a little bit, it puts strain on the market makers. The market makers kind of pull back from providing liquidity, or at least from providing resting liquidity. But that kind of paradoxically creates this area where price gets stuck. That's why you get these things, like we can see it here in the 10-year treasury chart, right? We've had a buy pretty much all day. Look at that. Pretty much all day they've been buying. But here, it just went flat. What happened? Well, we moved up here, right? And when that happens, the market makers, the latent liquidity, they don't want to execute there anymore. And so what you saw here at this price was price just going back and forth across that, what was it, 09, 08 half? 08 half? Back and forth across that 08 half over and over again. So the amount of liquidity for you to execute at any one given time is less, essentially. Because you're going to see it's going to go back and forth, and they only put up like 500 contracts. But because it stays there for so long, you can execute way more in this location than you can anywhere else. So what they're going to do is they're going to push things, which was probably this right here. They push things to kind of create that hole, and then they pull back on the amount that they're executing to fill as much as they can through this area. Okay. So essentially they execute in legs. They execute in legs, and once it's been long enough, the market liquidity has recovered, then they push it again. Push it again until the market maker becomes strained. And so when they do that, they find that the price that they get is better. And that's why they do that. So you can look up, there's this study about from Walrasian auction to continuous auction, where Jean-Philippe Bouchot kind of shows how some attributes about the order book and the optimal strategies that a market maker is going to use leads to this behavior. And then you can read about Almgren and Chris, which was kind of the first algorithm to really like quantitatively express this whole like doing things in waves, and that if you minimize your impact on the liquidity, it actually gives you better execution and so forth. Okay, so that's why they do that. What is the logic behind a news release? So I don't know how they do it exactly now, but they definitely get briefings for every news release that kind of goes through scenarios. You know, they're kind of going to be more on the like, what is the reaction function, right? They could probably very easily adjust that to kind of more my view of things, which is like how many orders is this piece of news going to prompt, right? So I'm looking at it and I'm drawing out scenarios based on, okay, if the number is this, I'm going to see this many orders buy, and if the scenario is this, then I'm going to see this many orders sell, or something like that. So they do kind of have like different range of options, and then depending on which one it does, they execute their plan. Can you explain how you utilize the spread and inventory cost basis indicators? Do they confirm that the move that you just explained? So the behavior that I was just talking about is just kind of something that you can see in markets. Follows the square root law. You're going to see this sort of a pattern. Okay. Now the cost basis, unfortunately, my order flow is screwed up, so I can't really give you a good example today. I can't really show you what the cost basis is doing today, at least. And it doesn't go back far enough. What if I just, I'm kind of don't want to reset it because it might change my algorithm. Suffer that the algorithm hasn't taken any trades. You know, let's try it. Let's just try and reload all the historical data and see if it screws it up. This isn't an issue with my indicators. It's an issue with NinjaTrader. Sometimes it doesn't give me the tick data. Okay. So here's how I use the inventory cost basis. So remember, the inventory cost basis is essentially saying it's kind of drawing out different scenarios about what market makers might, what kind of inventory the market makers have made and what they paid for that inventory. So this blue line is saying that is essentially the average price that a buyer has paid for their buy side inventory over the whole session. And similarly with the sell, this is what the seller would have, right? This line right here, this dotted line is, okay, well, the market maker, when he takes on some inventory and then takes some inventory off, he makes money from it, right? So how much money has he made and what would be like his break even for the day based on his current the inventory is currently holding, and that's what that line is. Okay, so what we find is it is extremely difficult for price to stay above that dotted line. Okay, the only time that you will see them spend a lot of time considerably above that dotted line is trend days. Okay, on a trend day, they just ride the line the whole way. So in this situation, if I had somehow caught this down in here for whatever reason, I would be seriously thinking about taking it off. Not that it's not going to go higher, but you're really likely to see a pullback from here, right? Basically, this becomes a place where you end up seeing a liquidity hole. Very, very common there, right? The other setup that we see that works really, really well with the inventory cost basis is, what if something happened that somebody said something or some comment that really came in and caused the treasuries to sell, right? How far would it sell? And what you're going to find is if you had a big sell bar, it would almost certainly go to here. It will go to that middle line, one of those two middle lines. In this case, probably the further one. Literally every time. It's really crazy. So these lines become really effective targets. I've been unable to find any sort of a setup where, like, crossing this line or whatever becomes a really good setup to enter a trade and then yada, yada, yada. It doesn't. Because the issue is the thing that is really, really that really determines where price goes is the market orders. Okay, the market orders don't necessarily care what the market maker is holding, right? So that's why you can get these days where on a trend day that they just ride this line the whole way, right? Okay, the market orders are what's going to determine where things are going. But in situations where what the market maker does matters, like there was a big news event and so they just dump all of their inventory, then these lines are really, really effective at predicting what price it's going to go to at the very least, right? So this is the issue. I can't predict, there is something that's going to come in and push them down like that, right? That's going to be a complete surprise. But if it does happen, I at least know where it's going to go to. So that's how we utilize that, okay? Now, the spread indicator, I'm not 100% sure which one you're talking about. I think that you're talking about just the spread, yeah. Okay, so what that is, this is actually, I wasn't sure if you were talking about the order flow spread. I think that's called something different anyways. Okay. Actually, This is a good example. Well, maybe not. This right here is the spread. Okay. Basically, what it's showing me is it's showing me ZN minus ZB. Right now, or this one is ZN ZT. So it's like 4 ZT and 1 ZN. Okay. So what it's really showing me is what the yield curve is doing. Up means that the yield curve is steepening, and down means that the yield curve is flattening. Well, today's not a good example because the yield curve isn't really moving. But later today, when the Federal Reserve does its thing, it's going to be very important to understand, is the yield curve steepening or flattening, and why might that be, and what the implications of that might be. You can come and add it onto a chart here, right? So what we see is that after this craziness, that the yield curve has flattened back out quite a bit, which kind of suggests that the economic uncertainty and volatility has decreased, right? So that can be really useful. One, because it will tell me which instrument is going to move more, right? So if we're steepening, you think of it as, again, up is steep and down is flat. So if we were to steepen, and usually when we are buying, we tend to be steepening, and when we're selling, we tend to be flattening. Okay, generally speaking, but that's not always the case, right? But in this case, we are moving up. So if we're moving up and we're steepening, then I would rather be buying the 5-year, right? Up. I want to be buying the 5-year. Conversely, if we were moving up and we were flattening, which happens a lot, what used to happen a lot, you want to do it in ZB instead. You're going to make more if you do it in ZB. So that's kind of one thing that you can do. So I can know in this situation, if we were flattening and we were moving up, I would be a little bit less prone to taking a trade in ZN, essentially, right? Depending on the regime that we're in, because I want to be like on the right side of the spread. But the other thing is that, if we are moving up, okay, like if we are steepening, I might see a lot of selling volume in ZB. And if I'm just reading the order flow in ZB on its own, that would be like, oh, I should be selling, right? And then it just keeps going up and keeps going up. And and what's happening is you're not able to differentiate that order flow. You're not seeing that, oh, that selling in ZB is not people that are betting on ZB going down. That's just orders from the spread. So I kind of have to discount them, right? So especially for treasuries, that spread indicator is very, very valuable because it kind of tells us tells us a story about what's going on with the yield curve. Now you can do the same thing with ES, N, and Q. And I have that on the chart over here as well. That's this one right here, right? So what we're seeing right now is that I believe it means that ES is outperforming compared to NQ, which kind of means that the market is still a little bit risk averse. Might mean that you might have a better time with your shorts than your longs today. But again, that's also something that when you're watching the order flow over here on the DOM, you might have to consider that there are people taking spread trades between ES and NQ and, kind of pull that flow out. I know, not a very good example because there's so many flows over in ES that it's just kind of a wash, and I don't know if you can really sort that whole complex puzzle out, but that's essentially the way that you use it. Do all bond traders use relative value? I think that you would have a hard time trading the treasuries without watching multiple instruments and kind of sorting out what's going on in the yield curve. It's a very significant part of what we do. Okay, you said you only watch the bid and the ask. I don't know what you mean by that. Were you talking about when I was saying yesterday that I pay attention primarily to the inside two prices? Well, cumulative delta is basically just telling me, are they buying or selling, right? So when I'm watching the DOM, I'm going to see, okay, 2000 sold here at 12, 1975 bought here at 12.5. Okay, but you know, it goes up and down, things like that. It's very difficult for me to track, is there more actual market buying compared to market selling, right? So that's why I have the cumulative delta up. Look at the cumulative delta, and that tells me very clearly. And we identified it very early on, didn't we? There's somebody buying. There's persistent imbalance in the order book. Sorry, there's a persistent imbalance between market buyers and market sellers in favor of market buyers. So we move up. And remember, what we're looking for is like a state, right? The state is there is a large meta order active in the market. Somebody is buying or selling a huge amount of it. Because when that happens, that's when you get trends. That's when you have an opportunity to buy something and it keeps going. Right? So cumulative delta is one of the best indications that we have that's happening. There are things that you're going to see in the order book too, but I think that cumulative delta is probably the most important thing. Now I can see that here on the inside here, right? But that's kind of hard to track, so that's why cumulative delta is really, really valuable. But I'm still going to be combining it with things like how much activity is there in bids versus offers? How much are the bids versus offers pulling? Every time that we tick up or down, how many contracts pull? Looking for changes in that. How many contracts stack? Looking for changes in that. Situations where it's like, oh, the buyers, they just gobbled everything that was available there. That goes a long way towards helping me see the current state of the market first, and maybe some hints about what those people that are trying to execute are doing and how they're doing it. And that's all just kind of little pieces of information that I'm combining together to determine the chances that we're in that state when there's a large meta order in the market. Are you scalping or swing trading? I don't necessarily like to use terms like that just because they mean different things to different people. But when I take a trade, I usually intend on holding it for as long as I can. I usually have a target based on cumulative delta. Like I will say, okay, I think that we're going to get a slightly larger than average size move. So I think that we're going to go 20 or 30,000 contracts net change in cumulative delta. So when we get to 30,000, wherever we are at that point, and that's where I take my profit, right? But if I can hold it for the whole session, like 2 hours, those are going to be my best trades. Is that scalping? Depends on your definition. I don't know if the definitions of scalping really apply anymore. Is it swing trading? I'd say probably not. But I am kind of moving towards doing more swing trades. So. I've never seen your setup on YouTube. Yeah, I don't know. I'm not gonna say that it's that unique. You know, I really patterned what I did from the No BS day trading course, and that is a very popular course in order flow. Okay. But most people are trading equity indexes. So you might see them put a DOM up, but they care about the charts. So, you know, most people are most retail traders are focused on a bunch of nonsense that doesn't matter. Yeah, I had this conversation a while ago. There was a person that used to come to our stream. And he was kind of like, oh, I have this thing. It totally works. I'll show you. And he showed me like his results. And I was like, well, okay, that's pretty impressive. Like we can try it for a while. We tried it for a while and like worked for a little bit. And then it just like started failing hard. And was like, nope, that really doesn't work. And eventually he went away. But one of the things that always drove me crazy with this guy was that he lived here in Utah, and he was very much about, because in Utah the dominant religion is Mormonism, right? Everybody's Mormon. It very much dominates the culture, and he didn't like that. He was like, he thought, you know, that taking things on faith was foolish, right? And so he was very much on the, you know, like what you believe, you should have like some sort of scientific backing to it, right? And so he was constantly making fun of people that were like flat earthers and things like that. But then when it came to his own trading, he didn't practice that. He traded something that he was basically taking on faith that it worked, because it had worked for him for some period, right? But the reality is that most of what retail traders are doing, especially when they're looking at intraday charts and trying to predict things, look for patterns in intraday charts, is really comparable to being a flat earther. Every piece of empirical evidence that we've done, and there's a lot of money in it, so there's been a lot of research done on this. Every single piece of research that I've ever seen on this subject comes out the same, that intraday prices are essentially martingales and do not predict future prices very effectively. So like, why should I be looking for a pattern in the chart? It just doesn't make any sense. It's flat earth or nonsense. But that's like the entire retail day trading space. and I have a really hard time understanding why, you know, when we're on the internet, people make such a big deal about, well, you need to look at the science when we're talking about climate change, even though I kind of think that our ability, like our current science there is, you know, limited in, you know, it's still a very young understanding of it, right? And then just they don't practice that in their trading. It makes no sense. I want to make my trading based on empiricism as much as possible. Like, there's always going to be a point at which you have to take a leap of faith, because you might know a certain property about the market or whatever, but you don't know everything that's possibly going to happen in a market. So every trade is, to some degree, a leap of faith, right? But we want to at least be jumping from a foundation, right? If I'm going to go and I'm going to take a huge leap, I would rather be jumping off of a rock rather than sand, you know? And so that's the way that we've patterned our channel is I try and look for research and things that will prove that the market actually exhibits the behaviors that we're describing. So when we look at what are the things about the market that we can prove, there's not a whole lot that you can prove about intraday price other than that it is basically martingales. But when you get into order flow, there's a lot of properties. And so when we're coming in here and we're watching the DOM, we're kind of looking for that behaviors. The most important one being that there's strong autocorrelation in the sign of order flows. That is to say, if there's a net imbalance in favor of market buyers now, there's a very good chance that that will hold an hour from now. Okay, because and we believe, or at least what the research indicates at this point, because other models really did not fit. What the research indicates is that the reason that happens, the reason trends happen, is because there are large players that are buying a large amount of it, and it just takes a really long time for them to do that. The needs of institution just absolutely dwarfs the actual amount of liquidity available in the markets. So that's the most useful piece of information that we have. And that's why we watch the order flow. And there's a lot of research out there where they're taking order flow and putting them into machine learning models and basically kind of like trying to digitize our own trader intuition is what it's doing. And they find that order flow can have extremely predictive short-term signals. So that's another piece of empirical research that you can kind of use. Meanwhile, I've never seen a single piece of evidence whatsoever that, you know, the market tends to form fair value gaps and goes back to them, and all of that nonsense is just nonsense. There's no evidence backing it whatsoever. Well, very interesting to me, the robot took a big trade there. So essentially the flows have kind of turned around. We are starting to sell a little bit, and there was like a huge hit. Like we went down like 3 ticks all at once. It was quite big. And the algorithm like immediately picked up on it and went short. Now, I personally would not like getting in a spot like that, because what will tend to happen is we might get stuck here a little bit. But it does kind of look like things might be turning into a sell. So we'll see if it gets something out of it. Unfortunately, we're going to be ending here in like 3 minutes. So I don't think that we will be able to... you know, we won't be here to see what happens. Let's see. I saw another comment here. Are candlestick patterns similar to reading tea leaves? Okay, so candlesticks, here's how I would describe candlestick patterns. Let's say that we went out to the barn in the backyard and I took a shotgun out and I shot the side of the barn like a few dozen times. And then I looked at the barn and I said, okay, where is the place where the most bullets hit? Okay. And then I'm going to have you stand in front of the barn with an apple on your head and I'm going to shoot it. Because see, look at how accurate it was. This is where the most bullet holes win. So you should be able to just stand there with the apple on your head, right? It's absolutely ridiculous, right? This is what we call data snooping bias. You're looking at the past market, and because you're doing that, you tend to fall into this bias where you will find a pattern that is actually just random. It was just a happen chance that it happened like that, and there's not any actual real edge to it. So if you go and you look at candlestick patterns and you backtest them, you're going to find that there's like one pattern that clearly performs better than all of the other patterns. But then if you go and you run that analysis on a different year, it'll flip around and that pattern will be like the absolute worst and some other pattern will be the one that works well. So it's not really a whole lot of anything to candlestick patterns that I've seen. I'm running a deep research in ChatGPT 03 to find empirical evidence of candlestick charts versus order flow. I totally believe you. I just want to see the inner workings. Yeah. So the issue that you're going to run into with that is that ChatGPT will definitely give you a different answer depending on the context that you put into it. Because I've had ChatGPT help me write videos about these sorts of things. I don't know. I had it do a little bit of research about like support and resistance, and it actually was able to find some stuff. But they were basically like, okay, there is a study that provides some support for the idea of support and resistance, but it's only on time periods of 90 seconds, and trading it does not make up for the cost of transactions. So it's kind of like there are people out there trying to trade support and resistance, but it's not a strong enough effect for you to make money off of it. That's what it said. But again, like what it's going to say is going to be based on context, right? Because what it's really doing is it's kind of taking the context that you've given it and it's looking out on the internet for places where people said a similar sort of a thing. So one of the things is you really want to provide it a context that will get it to look at empirical research. Like use the term empirical might be one thing that will help. But we'll see. Maybe it will provide some studies we can go and read. Might be fun. You did hammer it. Well, there you go. All right, guys. Well, it is time for me to get going. So I will see you. Have fun with the Federal Reserve Day. I will be watching and I will be in chat. I can't stream. So head over to our Discord in the video description or the $3 Discord. I think I'm probably going to put a lot of information there, or I'm going to try to. So see you guys there. In the meantime, stay excellent, team.